Okay, so we are going to continue our discussion on the financial instruments, but this one we are going to look at what we call the hybrid instrument or the compound instruments. So last time we looked at the liability, we look at the financial instruments, which is about liability, where a company will be issuing debentures, bonds to other parties, and people will buy. So they have an obligation towards those people, so they have to recognize a liability. But we can also have a situation where a company will issue an instrument which will have a characteristics of a liability at the same time a characteristics of equity, which we call the compound instrument. So hybrid or compound instrument is that instrument that is having a component of debt and also a component of equity. Mostly it will be a convertible instrument. They will give you a question and say that the holders of the instrument has the right to convert the instrument into equity shares or 2-for-1 equity shares at a price of this, or it will be redeemed at par. So the question will tell you that, and the hybrid instrument is always a convertible instrument, the instrument that is likely to be converted into equity shares. If the instrument is likely to be converted to equity shares, it means that there is an equity component in that particular instrument. So we are going to look at what we call the compound instruments, instruments having a component of equity and a component of debt. But the question is, they can give you that the instrument was issued for 10 million. Okay, the instrument was issued for 10 million. Nobody is telling you the part of it that is for equity, the part of it that is for debt. But the question is, how do we separate the debt and the equity component? How do we separate the debt and the equity component? Okay, for you to get the equity component and the debt component, okay, so the debt component and then the equity component. The debt component is always the cash portion. The debt component of the instrument is only the cash portion. And the equity component is the difference between the nominal value, the nominal value, the difference between the nominal value and then the cash component or the debt component. Okay. Okay. If I say the cash component, what is the meaning? Or the cash portion? Okay. The debt will always be the cash flows that the people will be receiving from the instrument. So if the instrument is 10 million, what is the amount that we are paying every year? What is the interest that we are paying every year to the people? That particular interest is paid to the debt holders because interest is paid to debt holders, not equity holders. Equity holders receive what? Dividends. So you will be paying interest at the end of every year, and that particular interest is for the debt holders. So we take the interest that we are paying in cash, then at the end of the maturity date, we will either redeem the instruments, either at a par or at a premium. The question will tell you. So that amount, that redemption amount will be paid to the debt holders. But we don't redeem equity, we redeem only debts. So the redemption value will also be for the debt holders. So what we do is that the debt components, the debt components, debt components, the debt components. Okay. A debt component is calculated like this. Okay. The issue is at the end of every year, I'm giving you interest of 2 million. And this interest will be paid for 3 years. So it means that the first year is second year will also be 2 million. third year will also be 2 million. Okay. So in the third year, then I will redeem this one. Maybe it is 10 million. So I'll redeem at 10 million. Okay. Okay. All right. So this is the amount I'm going to be paying to you. So every year I'll pay interest of 2 million, 2 million, 2 million for 3 years. And at the end of the third year, I'll pay your amount to you. Okay. The question now is, it is a certain amount of money that I'm paying you this interest on. It is certain amount of money that I'm paying you in this interest on. Or you have given me a certain amount of money today. That is why I'm giving you this interest because of time value of money. That is why you are taking this amount of money from me. So it means that if all this money I'm giving to you, all this money I'm giving to you, that will be given to you in the future. The question is, what is the portion of the amount that you are giving to me before I'm giving you this cash flow? So what we do is that we try to present value all these cash payments, or we try to find the value of the debts. How do you find the value of a debt? You have given me a certain amount of money today, and this is why I'm giving, that is the reason I'm giving you this cash. And these are all future cash flows. So if I try to present value, this particular value, it will represent the current value of the amount that you have given to me before I'm giving you this interest and this amount because of time value of money. So what we do is that we find the debt component by finding the present value of all the cash flows. All the cash flows. Or basically, those who have done financial management, what we do is that we try to find the value of the debts. How do we find the value of the debt? We use the cost of the debts to present value all the cash flows. If you add them up, that is the value of the debts. So the debt component is calculated as the present value of all the cash flows. If you are calculating present value, you need a discount factor. You need a discount factor. So which discount factor are we going to use? We use the discount factor. We use the discount factor. The discount factor. So we use the discount factor of a similar instrument. Of a similar instrument without convention rights. So the issue is, if we are saying that we are going to convert this one at the end of this one, first what you do is that you account for it as if there's no convention for the 3 period. So after the maturity period, before the people will exercise their convention right. So we look at how we do the entries for the convention to maybe at the end of the maturity period. But what we do is that, do we have any other instruments in a different company, a similar instrument in a different company where they have not attached a convention right to it? If yes, we use the discount factor or the market rate of that particular one, or we use the discount factor or the interest rate of a similar bond with a similar risk for the instrument that we have. So how do we find the discount factor? How do we find the cash flows? We do it like, we have the years. We have all seen how we do cash flow, how we find present value. We have the cash flow. We have the discount factor. Then we have the present value. So assuming this is 10%, so this will be 10%. Okay, so we have year one, which will be 2 million. Then we have maybe 0.909. Then you have the second year, 2 million, which will be 0.861 or something. Then we have the year three. The year three will be this plus this, which will be 12 million. So let's assume that is 0.758. So you just do it. But if you can't do it one by one, you can use what we call annuity, because you can see that the person is going to pay what? 2 million each year for 3 years. So it means that annuity is an equal amount that will be paid at the end of every year. So you can use annuity, which is 1 to 3, before you do the present value of the redemption value. But this 2 million, what is the 2 million? The 2 million is the coupon. Is a coupon that they are going to pay. So at the end of every year, they will pay the coupon, the interest on the what? On the debt component. And that is always calculated as the interest rate, which is the nominal rate times the nominal value, which might be on this particular value. So there might be 20% on this one, and that will give you the 2 million. Okay. So that is how we go about the hybrid instrument. We separate the debt component from the equity component and subsequently account for the debt component using the amortized cost, what we have done the last time. So on the date of the transaction, you have to separate the debt component from the equity components. After that, then you account for the debt component. So initial measurement is separating of the debt component from the equity component. Then the subsequent measurement is that you subject the debt component to amortized cost, but the equity component will not be remeasured. Equity component will not be remeasured. And where do we put the equity component? It will be sent to other component of equity. Okay. So that is all about this one. The separation is we find the debt component, which is the present value of all the cash flows that will be paid to the debt holders. Then the difference between the present value and then the nominal value will give you the equity component. Subsequently, the debt component will be accounted for using the amortized cost, because it will be for more than a year or 2 or 3. So that will be a non-current liability. So that is it. All right. The question now is, you see that the last time we have an issue with transaction costs and discounts. Okay. If there's a discount, what we do is that the discount will be net against this particular value. So we subtract the discount before we find the equity component. So if there's a discount, the discount will be subtracted from this one. So assuming the discount is 0.5 million, it means that after finding the present value over here, you compare the present value to 9.5 million. That is the discount. So if there's a discount, the discount will be subtracted from the nominal value before we find the debt component. But if there's a transaction cost, this is how we go about a transaction cost. If there's a transaction cost, what we do is that we don't net the transaction cost against the nominal value, because the transaction cost, part of it will be for equity, part of it will be for debt. So what we do is that you still use your 10 million. So if the transaction cost is 0.5 million, you will still use your 10 million to determine your debt and equity. So you find the present value of all the cash flows, you compare it with the 10 million and get the equity component. So assuming our present value of the cash flow, which is the debt component, is 9.5, it means that equity will be 0.5. So if there is a transaction cost of 0.5, what we do is that we now share the transaction cost among the equity and debt component in their proportion. So that will be, debt will be 9.5 divided by 10 times 0.5, and equity will be 0.5 divided by 10 times 0.5. So that's how we find the proportion of the issue cost or the transaction cost for each of them. But if it should be a discount, the discount will be subtracted. If there's a discount, it means that the discount is net against the what? The nominal value. So it means that we are not receiving 10 million, but we are receiving 9.5. But if there's an issue cost, part of the issue cost will be for the equity, part will be for the debt. But if you are subtracting the issue cost from the nominal value, it means that how you are subtracting it. If you subtract, there is no problem with that. But it means that what will happen is that maybe the equity will be having higher of the issue cost than this one. So The best way is that just use their proportion of their value to apportion the issue cost to them. So there might be an issue of issue cost in the question. Then you have to look at how you go about the sharing or the allocation of the issue cost, and this is how it is done. Okay, without wasting much time, let's pick some questions and at least 2 questions. Then we know that we are done with the compound instruments. Then we move on to something else. All right. Okay, let's look at question 2. Someone should take the question 2 for us.
T issued 1 million convertible bond on January 1, 20x6. The bond had a term of 3 years and were issued for their fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum. Bonds without the conversion option attracted an interest rate of 9% per annum on 1st June 20x6. The company incurred issue cost of 1 million. The impact of the issue cost is to increase the effective interest rate to 9.38%. At 31st May 20x9, the bondholders can opt to be repaid their par value in cash, or they can opt to receive fixed number of ordinary shares in Tom T. Required discuss accounting treatment of the convertible bond in the financial statement for year end of 31st May 20x7.
Okay. Okay. So these people, their reporting period is June to May, isn't it? Okay. So this one, the question you didn't see this one, but if you look at the date that the instrument was issued, 1st June, and the reporting date is 31st May. So it means that their reporting period is from June to May. Okay. Sometimes the question can tell you that their reporting period is this and this. They report up to 31st May. Okay. But sometimes you can use you can be able to use some of the things in the question to determine their reporting period. All right. So they have issued 1 million convertible bonds on 1st June. The bonds had a term of 3 years and were issued at their fair value of 100 million Ghana cedis. Okay. Which is also the par value. Interest is paid annually in arrears at rate of 6% per annum. Bonds without the conversion option attracted an interest rate of 9% per annum on 1st June 2x6. The company incurred issue cost of 1 million. The impact of the issue cost is to increase the effective interest rate to 9.38. At 31 May, the bondholders can opt to repay the par value in cash, or they can opt to receive a fixed number of ordinary shares in one pot. Oh, it's supposed to be the same something. Okay, so this is supposed to be the same name. Okay, sorry about that. All right. So the first thing that is that this is a convertible instrument. The question can decide to ignore the convertible instrument, but they can say that the instrument can be converted into this and this and this. It means that that is a compound, or that is a convertible instrument. Okay, the question is, what is the amount that we'll be paying to the debt holders every year as interest? What will be the amount that we'll be paying to the debt holders every year as interest? Would that be 6 million?
Yes, 6 million.
Okay.
million.
So that will be 6 million, which will be paid to them for 3 years, isn't it? So we pay the interest at the coupon. The coupon is the interest that we're paying to them. That is a guaranteed interest. So 6% on the 100 million will give us 6 million. And that will be paid for 3 years. Okay. And at the end of the third year, what will happen? We will pay their money back to them in cash. So at 31 May 2009, the bondholders can opt to be repaid the par value in cash. So what we do is that we just use the redemption value. So the par value is 100 million. So this is the cash flows that the debt holders will be receiving. Each year, they will be receiving interest of 6 million. But at the end of the third year, they will receive their what? Their value, which is the par value, 100 million. The question can say that the instrument will be redeemed at premium. So they say the interest will be redeemed, or the instrument will be redeemed at premium of 10%. It means that the redemption value has to be 110 million. It will be redeemed at premium. Premium is above the par value, which is the 10%. So you find 10% on the 100 million and still add it to the 100 million. So it means that it will be redeemed at what? 110 million. In that case, your redemption value will be 110 million. But in most cases, it will be redeemed at par, which is the 100 million. So for you to be able to find a debt component, this is what we going to do. So the debt component, separation of the debt component. So separation of debt component, debt and equity components. Okay. So the first one will always be the debt component. You can only calculate the debt component. Okay. So we have the years, we have the cash flow, we have the discount factor, and we have the present value. The question is, what discount factor are we going to be using? What will be the discount factor? What will be the discount factor that we are going to use?
The 9.38.
No, please.
But there's how do you call it? There's issuing cost.
The 9.3 will be used on only the debt after we have separated the debts.
Oh, okay. Then it's a 9%.
It's 9%. Okay. So we use.
Please, can you take it over again, please?
Okay, we use bonds. We use the interest of bonds without the convention option or rights. So
Yes.
the question over here, the bonds without a conversion option attracted the interest rate of 9% per annum. So we are going to use the 9% per annum. But
Okay.
you can see that we have an issuing cost, but the issuing cost will not be subtracted from the 100 million before we do the separation. So we can't use the 9.38 because the issue cost is not taken into consideration before separating the debt and the equity component. But if you come to the debt component, the subsequent measurement will be you are going to net the issue cost against the what? The actual value that we have gotten from the separation. So in that case, you have to take into consideration the impact of the issue cost. So this will now be 9.38. This will be the subsequent rate for the debt component. But at the date of the separation, the issue cost will not be taken into consideration. But if you should subtract the issuing cost from the 100 million before you do the separation, then you have to take the 9.38 as the interest rate. But we are not taking the issuing cost into consideration. So it means that it must be discounted at 9%, which is without the effect of the issuing cost. Nick, I hope you're okay.
So if we were using 9.38, we would have taken the issuing cost from the 100 million before we discount.
Yes, yes, please. Nick, yeah, that's how you're going to do it.
Yeah, okay.
Okay. But that one we don't do. The issuing cost will be shared among them in the proportion of their values. So that is why we take the issuing cost into consideration. But the date of separation, issuing cost will not be taken into consideration. So you just use the the interest rate without the conversion option or rights. Okay. So let's take our values one by one. So we are going to, should we use annuity or we should do it one by one?
One by one.
Okay. So, but you have to know that if you go to the exam hall where the year is 5 years, one by one is going to waste your time. Okay. So this will be 6 million. So the interest, which is the coupon, will be 6 million, which is 6% on 100 million. Okay, the discount factor is 9%. Let's count to 2. That will also be 6 million. If we count to 3, the 3 will be 6 million plus the 100 million. That will be 106 million. Okay. So you'll be receiving interest of 6 million at the end of every year. But at the end of the last year, which is the 3rd year, you receive the interest in addition to the nominal value, which is 100 million. So interest plus the 6 plus the 100 million will give us 106. What is the discount factor for year 1? 9%. The discount factor for year 1 at 9%. What are we getting? So none of us is having scientific calculator.
0.917.
0.917.
Okay, 0.917. Year 2.
0.8416.
0.842.
0.842. Year 3.
0.72.
842.
772.
772. Okay, let's do the multiplication now. So what will be the present value? Thirteen 5.502. Okay.
Year 3 will be 81.83.
81.83. Okay. Year 2 will be what?
5.052.
5.05. Okay. Let's put all together. That will give you the debt components.
$92.38.
92.38. Okay. So that is the debt component. Let's calculate the equity component. So the money that we receive is 100 million, but the present value of the debt, the market value of the debt is 92.38. The meaning is that equity will be how much?
7.62.
Okay, 7.62. So that is the present value or the market value of the debt is 92.38. And the present value the money that we have, the present value that we have is 100. So it means that the remaining portion of it will be for the equity. So this is how we go about it. But we have to look at the allocation or the apportionment of the transaction cost. How do we apportion the transaction cost? So we come to the debt component. What portion will go for the debt component? The debt component will take 92.38 over 100 times the 1 million. How much are we getting?
0.92.
0.
I said, please, what's the meaning of the TC?
Transaction cost.
Mm,
0. What?
90.
92. Okay, let's come to the equity component. The equity component will be 7.62 divided by 100 times 1 million. That will give us
0.08.
0.08. They are all in million. Okay, so what we do is that the equity component, what we do is that the equity component will go to other component of equity. So equity component will be calculated as a 7.63 plus 0.08. Because this is a transaction cost, if you are capitalizing, it will be added. So this is going to be having a debit balance. So if you are capitalizing, it means that it will be debited to the equity accounts. Okay.
7.70.
I'm coming. The equity will be having a credit balance, isn't it? So
Yes.
it's supposed not to be added. It's supposed to be subtracted. So the equity will also be subtracted, not addition. So that will be minus. Let's come here. The equity also will be seen as a debt. Okay. So that will give us what?
7.5.
7.554.
Yeah.
54.
Okay, 7.54. A debt component will also be the 92.38 minus 0.92. So let's get the remaining value. So what to be the fair value of the debt? Fair value of the debt component. Okay, someone can calculate it like this as the face value, maybe which is the value that we have gotten from the separation, which is 92.38. Let's make it million. The person will bring the transaction cost, which is 0.92. And this will be a subtraction. So what are we getting?
91.46.
I thought we add rather.
Now this is debt. So debt is having a credit balance. So the transaction cost is an expense. If
Okay.
capitalize, it will be a debit to this account. Okay. So that will be 91.46.
91.46.
Okay. 91.46. So we do the subsequent measurement. All these things, we are doing it at the date of what? The issuance, which is the 1st June. But from 1st June to 31 May, what will happen? It means that this will be fair value. So we look at the subsequent measurement. It's only the debt component that will be subsequently be fair value. So subsequent measurements, what we are going to have is that the debt component will be subjected to the amortized what cost. So what we do is we have the fair value of the debt, 91.46 million. Then we have the finance cost. Okay, the finance cost. The finance cost, assuming there is no transaction cost, the interest rate that we'll be using is the 9%. So assuming there's no transaction cost, we are going to be using 92.38. That means that the interest rate that we are going to use will be 9%. But whereas the case, there's a transaction cost. So it means that we have to use an interest rate that is going to have the impact of the transaction cost, and that will be the 9.3%. So it will be 0.0938 times 91.46, and that will give us the finance cost. So if there is a transaction cost, then you have to use the interest rate, which constitute the impact of what the transaction cost and also the interest that you should have been paying every year, and that will be the 9.3%. So what would be the finance cost?
8.58.
8.58. Okay. So at the end of the year, the people are going to receive their what? Their actual interest payment, which will be the coupon rate multiplied by the 100 million, which will be 6. So it means that at the end of the year, they will receive their coupon payment, which will be 6 million. So what will be the value that will be remaining?
$94.04.
94.04. So that will be the balance at the end. So you come to your statement of profit or loss. Maybe first of all, you do your calculating, then you do your presentation. If you are doing, these are just like note to the accounts. So after the note, what do? You have to come and put the figures on the face of the what? The financial statements. So you come to statement of profit or loss. So the calculation and the presentation is very important. If you want to get your full marks, the calculation is as important as the presentation. But the calculation will be the one to take the highest mark. So if you don't want to present, that is your own issue. So you have the finance cost of 8.58 as an expense. You come to statement of financial position. Then you have your financial liability. Your financial liability, which is a debt one. And that will be 94.04. Then you come to other component of equity. So this will be for liability side. So you can put liability at the top there. Then you come to the down, you put equity. So you can put equity here. Then you have your other component of equity, which will be the equity side, which is 7.54. Okay. So that is all about this one. That is all about this one. It's not really anything difficult. It's very simple. Yeah, Zina.
Then the subsequent measurement also take the amortized cost table. Can we use the amortized cost table to calculate subsequent measurement?
You can only the amortized table, how you want to use it. I don't have any problem with that. But I only use the amortized table if I'm going to do the workings for more than a year.
Okay.
So if I'm going to do it for more than a year, you can see that this is the first year that I've done. So I'll go to the next year, but I can't do it like that. It will be plain C. So that is why we use a table to make it simplified, very simple. So if you like, you can use the table, but me, I only use the table when I'm going to do the computation for more than a year. So if they ask me to do it for all the 3 years, then I'll use the table because the table is going to make it very simple, and it's the time to and the space to will not be wasted. But if they say I should do it for a year, I'll always use a vertical presentation because it's for only a year.
Thank you.
So you can use a table. There's no problem with that. But I will encourage you to use a table if you are doing it for more than a year. All right. No, the board will be saved and share with you. So there is no problem with that. Let's take the next one. Then we know that we are done with compound instruments. We take 5 minutes and come back. Okay, and continue with financial assets. Okay. So let's take example 3. Nick, example 3.
On January 1st, 2021, WL issued 12.5 million bonds of 100 cities each for 1.25 million. The related transaction cost on issuance amounted to 50 million. Each bond is convertible on 31st December 2024 into 2 ordinary shares at the option of bondholders. Any converted bond will be redeemed on that date at par value. Under the terms of the bond, there is no interest on the bond 2021 and 2022. However, interest is payable at 16% per annum on 31st December 2023 and 2024. On the date of issue, market interest rate for similar debt without conversion option was 12% per annum payable each year. However, on account of transaction costs incurred on issuance of bonds, the effective interest rate would increase to 13.2 per annum. In the financial statement, the proceeds have been recorded as convertible bond classified under equity, and the transaction cost has been expensed out. Required.
Okay. Okay.
In line with IAS 32, financial instrument presentation and IFRS 9 financial instrument set out and discuss accounting treatment of the above issued bonds within WL's financial statement for the year ended 31st December 2021.
Thank you. Okay. Let's come here. I haven't spoken about if the people want to convert the bond, what will be the entry? So we will do that one for this one. Okay. So let's come here. All right. So the bonds were 12.5 million bonds. Each of them were issued at 100 cedi. It means that the total proceeds will be 12 million 1,215 million Ghana cedis. That's what they have given to us. So sometimes they will not give you the total. You have to calculate the total yourself. So you just take the number of bonds or the number of instruments that you have multiplied by the value per instrument. Okay, so this is the total process there. This is the total process that they have received. Okay, this is a bond. This is a bond. So on the face of it, this is a liability. This is a financial liability. But what is making it to be a convertible instrument? What is making it to be a convertible instrument? The related transaction cost on issuance amounted to 50 million. Each bond is convertible. So what is making it to be a convertible instrument is the right to convert. Okay, on 31 December 2024, into 2 ordinary shares at the option of the bondholders. Any unconverted bonds will be redeemed on that date at par. Under the terms of the bond, there is no interest on bond for 2021 and 2022. However, interest is payable at 16% per annum on 31 December 2023 and 2024. On the date of issue, the market interest rate for similar debt without conversion option was 12 million per annum, payable each year. So the conversion will be done at the end of the what? The reporting period or after the maturity period. That is why we are going to do the conversion. So what we do is that from the beginning of from the date of issuance to the maturity date, there won't be any conversion. The people will be having the money. It will be after the maturity date that the conversion will be done. So we account for the instrument during the maturity period as if there won't be any conversion. That's why we use the interest rate of a similar bond without what? A conversion right. Okay. So it is 12% per annum each year. However, on account of transaction costs on issuance of bonds, the effective interest rate will increase to 13.2% per annum. That is what we have done. In the financial statement, the proceeds have been recorded as convertible bonds classified under equity, and the transaction cost has been expensed out. So the question is, should we have expensed the transaction cost? Is that the right thing to do?
No.
Okay. So we go and rectify those entries that they have done. Okay. The first one is we have to separate the debt component from the equity component. How many years are they going to pay the interest? How many years would the coupon on this particular instrument be paid to the debt holders?
2 years.
It will be 2 years. That will be the third year and then the fourth year, isn't it?
Yes.
Okay. So it is nice that you'll be trying new questions. Okay. So maybe you go to the exam hall and see a question like this. You say that you haven't seen this before, and you'll be insulting whoever taught you financial instruments. Okay. So you have the years, we have the cash flow, and we have the discount factor, which is 12%. We have the present value. So you can see that year 1, year 2, the cash flow will be 0, 0. So you can decide to show it like that. Year 1 will be 0. Discount factor, you can put it there, but this will be 0. So if you like, you can just leave the year 1 and year 2. But for you to be able to know how you are going to use the discount factors, you can show the year 1 and year 2. Because if you start with year 3, if care is not taken, you'll be using the first year discount for the year 3. Okay, so you can start with 0, 0. But for me, since I know what I'm going to do,
Please, I want to know how we started with 0.
there is no interest payment for the first 2 years. So the people will receive 0 interest. I'm not starting, the years is 1. It is the cash flow and the present value that I'm making 0. So the years is 1. Auntie, are you okay?
Okay.
All right. So for me, I'll just start with the year 3 straightforward because I know what I'm going to do. So what will be the coupon payment that will be on the instrument every year? It is 16% on what? 12 million, 1,250 million. So that will give us how much? So 0 points. That will give us how much? 0.16 times 250. This is the coupon rate. Interest is payable per annum on this and this. But the convention, this one we had the convention is 12%.
200 million.
So what is the what is the amount there? How much are we going to get?
200 million.
20.
0.
Okay. Do you know under normal circumstance, the effective interest rate should be higher than what? The coupon rate. If you can pay attention to the questions that we have been solving, you see that the effective interest rate is always higher than the what? The coupon rate. Okay. But do you know why it is not higher?
No.
Yes, the reason is the interest. So you can see that they have accumulated the interest. The 2 years interest has been accumulated and it was paid in 2023 and 2024. So since you're not paying interest for the first 2 years, it means that you're not going the meaning is that they are not going to pay the interest at all. It doesn't mean they are not going to pay the interest at all. But they are giving them some period where they are going to pay the interest together with other interest in the subsequent year or something. It doesn't mean that it is free. No. So they are factor the interest for 2021, 2022 into 2023. That's why they are paying a higher interest. So it doesn't mean there's no interest payment for 2021 and 2022. There's no interest payment. There's an interest payment, but that what is happening is that they have sent the interest payment to what? To the subsequent years. All right. So if you calculate, what are you getting? What is the figure that we are getting? 0.16 times
200.
okay. So that will be 200. So we go and put our 200 here. So what will be the discount factor? Year 3.
0.71.
0.710. Let's come to year 4.
No, 12. 0.712.
712.
Okay. Let's come to year 4. Year 4, what will happen? Yes, senior.
Wait, is it not 2,000 instead of 200?
2,000.
Or I'm looking.
Hey, the nominal value is less than 2,000. So if the interest is 2,000, it's supposed to be 200. So it will be 16% on the 1250. So maybe you are making the zero at the end there to be, you're making it to be 12,500. Maybe that's why you're getting the 2,000. So calculate it again. 16% on the nominal value, which is 12. 1250. Is it 200? Senior, or the calculator is not with you.
It's 200.
Okay.
200 is correct. Yeah, I have
Okay.
that is correct.
Yeah, you make it 12,500. That is right.
That's correct.
Okay. Let's come to
Yes.
okay. Let's come to year 4. What will be the total value that they will be receiving in year 4?
1,450.
Okay, that will be 1,450. They are going to pay their nominal value of 1,250. Then they will receive interest of 1,450. What is the discount factor?
0.636.
0.636. Okay, so let's now find the present value and move on.
142.4.
Okay. What are you having?
142.4.
If you add the two,
No, I'm talking about year 3.
1064.6.
1064.
Yeah. Yeah, that's the total.
Okay. So I want to get only the year 3.
It's 922.2.
922.2. Okay. That's the third year is what?
142.4.
It's the first year the third year that you are mentioning 142. I'm getting it to be maybe 11 something something.
Okay.
But my mind is not here. Don't mind me. My mind is not here. My mind is somewhere else. Okay, 142.4.
4.
Okay. So if we add all, what are we getting?
10
064.
64.6 or
Okay. So this is the debt component, isn't it? Okay. So let's come to the equity component. The equity component will always be the difference. So our total amount was 1250. So what will be the equity component?
185.
185.4.
185.4. So let's look at the what? The apportionment of the transaction cost. So if you want to apportion the transaction cost, apportionment of the transaction cost, transaction cost. Okay. So the debt will be having 1064.6 divided by 1250 multiplied by 50 million. Am I correct?
Yes,
Okay.
that's
So
42.58.
40.58. Okay, let's come to the equity. Equity will be 185.4 divided by 1250 times 50.
7.40.
7.40. So this, what will be the impact of this one? So you have to find their value, their fair value. So debts, the debt components, their value will now be 1064.6 minus the 4258. So the accounting for the issuing cost will still be the same. The debt will be subtracted. Equity will also be subtracted because the equity is just an equity instrument which is going to be having a credit balance. So if you are capitalizing a transaction cost, you are going to debit it. It's an expense. So this will be how much?
022.02.
The 1064.6 minus 4258. What are we getting?
1022.02.
Okay, 1022. 1022.02.
Yes, please.
Okay. Let's come to the equity. That will be 185.4 minus 7.42. What are we getting?
177.98.
177.98. So we subject this one. This is just at the date of the issuance. This is at the date of what? The issuance. So what will happen from the date of the issuance to the reporting date? That is what we call the subsequent measurement. After recognizing this in your books, what are you going to do? So the recognition of this in your books will be like this. Okay. How are you going to recognize this in your books? The first one is you are going to debit your cash. You are going to debit your cash with the 1250. That is why you are going to debit your cash. Or since you are going to pay the transaction cost also, it means that the cash will now be 1,200. So you debit cash of 1,200. That is the net of the transaction cost. Then you credit liability of 1022.02. Then you credit equity of 177.98. That is the initial recognition. If you do the two, the debit will be 1,200. The credit will also be 1,200. That is the initial recognition. But what will happen subsequently? Subsequently, the debt component must be subject to what? Amortized cost, where you are going to be paying interest. So we have the fair value to be 1022.02. So we have our finance cost. Finance cost should be, our finance cost will be 0.132 because the interest rate is not 13%, multiplied by 1022.02. What are we getting?
134.9.
134.9.90. Would there be any coupon payment for 2021?
9 months.
It's 91.
Yeah.
Okay. Would there be any coupon payment for year one?
No.
No. So you just add the two. That will give you the liability at the end. So let's add. What are we getting at the end? What is the balance at end? You can easily get this balance at end by having 1.132 multiplied by the first value, 1.132 times 1022.02. I'm getting 1156.93. Okay. 1156.93. Okay. But what was the question? What did the question say? The question said what? Okay. The question said that in the financial statement, the proceeds have been recorded as convertible bond classified under equity, and the transaction cost has been expensed. So it means that the 50 million has been sent to profit or loss, and the 1250 has been classified as what? As convertible bond under equity. So we have to go and rectify this particular mistake. Okay. The question is, what should be in the amount that should go to profit or loss? From the calculation that we have done, our finance cost should be how much?
134.9.
134.9.
Okay. So we assume that the 50 million that has been charged to profit or loss is an expense. So what we do is that should be a portion of the finance cost taken there. So we only take the remaining figure there. Or you can go and reverse the entry, which you go and credit the profit or loss because the expense has been charged as a debit. So you go and credit and you now bring the transaction cost. Okay, but this one you can just bring the net amount. So you can have a finance cost. You can have a finance cost of 134.91 minus 50 because the 50 has already been charged as an expense. So what figure are we going to have? Okay, what figure are we going to have?
84.91.
84.91.
Please, the
84.91.
first one we deducted the coupon rate, but this time we didn't deduct the coupon rate.
Yes, because you are not paying attention.
Okay.
There's no coupon, there's no interest payment for year one and year two. So they are not going to pay anything. Auntie Salamatu, have you gotten it? There's no
Yeah.
there's no interest payment for year one, year two. So you won't do that. The only time that you deduct the coupon is the last 2 years, which is 2023 and 2024. So you can see that the question says that there is no interest payment. There is no interest payment. So under the terms of the bond, there is no interest on bond for this and this. So that is even the reason why we didn't use 2021 and 2022 because there won't be any interest payment for those 2 years. So 2022, what you do is there won't be any interest payment. It will be 2023 that you take your 200 as a coupon payment from the figure. Then 2024, you take the 200 again. Right. So this is how we go. This is how you can do it. But someone can also do, the person will bring the finance cost. The person will bring the full amount, which is 134.91 as an expense. The person will now reverse the transaction cost because this is supposed not to be expense. So the person will bring it as 50. because that will be treated as an income. First, it was treated as an expense. So what you do is that you can see that if you are doing this, the net amount is still what? 84.91. So you will still be on the same side if you do the net one. Okay, let's come to statements of a financial position. So let's have a liability. Let's have a liability. The liability will be a financial liability. And what will be the value for the financial liability? That will be 1156.93. I hope I'm correct. Then if you come to the equity, what will happen is that you have other components of equity. Other components of equity. Or they say it has been classified as convertible bond. So it has been classified as convertible bond. So you can still keep it like that. But this will be, it has been as 1250. Then the question is, what should have been the actual amount? The actual amount for equity should have been 117.98. So the question is, what figure, if we subtract it from this, we get our 177.98. So we just subtract because the question says that the proceeds has been shown as what? Convertible bond under equity. So you just go and show the actual figure for the equity. Equity should have been 117.98. But we are having 1250. So what we do is that we just reduce the 1250 to 177.98. And that will give us 1072. 1072. So we subtract 1072. 1072.02. So 1072.02. Something like that. Okay. That is all. So that is also about this question. But my focus is about you knowing that there can be an instrument with no interest payment for a certain number of years. Okay, so that is the focus. The focus is not about the presentation because the presentation will still be the same. But I just want to introduce you to a situation where you can have an instrument with no interest payments for a certain number of years, and you have to know how to do it. It's not difficult, but if you haven't seen it before, you'll be there, you don't know what to do. All right. So this is all about the compound instrument. I will end the meeting and we come back after 5 minutes. Any question?